Continuing with our central bank saga, we will elaborate on what monetary policy is and how it affects the economy. What monetary policy is. Monetary policy aims to prevent the economy from overheating during expansions or boosting the economy during recessions. Monetary policy is the main course of action for a central bank, and it is usually conducted through the manipulation of interest rates. Through interest rates, central banks affect the public's inclination to borrow. As interest rates increase, less people will find it profitable to borrow. This has important effects on the economy. Monetary policy and the economy. To elaborate on the effect, let's see an example. If the total cost of lending is 3%, then an investment with an expected return of 4% would be profitable. However, if the lending rate was raised to 4.5%, then an investment offering again 4% would no longer be that appealing. As such, people would be less willing to borrow for investments which yield low returns, and would also be less willing to borrow for those yielding higher returns, as these are, by definition, riskier. In a similar manner, higher interest rates would mean that more people are likely to just deposit their money at the bank instead of investing it elsewhere. This would mean that less money will go for investment purposes and more money will remain at the bank, again cooling off the economy. Finally, higher interest rates mean that existing borrowers will have to repay a larger amount of money back to the bank. This will have to be taken off their budget, thus reducing consumption and easing growth. Reducing the amount of lending is expected to stabilize the amount of money in the economy and hence ease inflationary pressures. The opposite would hold when the economy is in a recession. Central banks tend to lower interest rates when the economy is in a downturn in order to boost lending and consumption. To sum up, monetary policy affects the economy via 1. Affecting the attractiveness of new lending. 2. Impacting the return of bank deposits and thus their appeal. 3. Affecting the available income of borrowers.